Hi, everybody. Christian here. Joining us are Dorinda Hanson from CORE, Relationship Manager, and Kanae Corder is our hot seat participant, but we're going to wait to do that until later in the presentation. But thank you for joining us and volunteering to be the sacrificial lamb. So the topic of today's conversation is inflation and pricing. The group that I spoke to earlier today kind of reflected the sentiment that everybody's dealing with price increases. I don't think there's any debate or any question about that. I think the question is what's it going to do in the future, and how do we deal with it? Some of the data I'm going to show you, I had seen last like third quarter, and it was clear that inflation was coming. And so we were ringing the alarm bells almost 9 months ago. So some of this is a little belated, but I don't think inflation is going anywhere anytime soon. I would love to get feedback from anybody via the chat feature with your questions, as well as any experience that you'd like to share with the group. So here's my ugly picture and my email if anybody wants to hit me up. The topic, the agenda, going to talk about what the current situation is regarding inflation and prices, and we're going to talk briefly about the strategies, business strategies, labor strategies, and pricing strategies to deal with that. And then we're going to go to the hot seat, and we're going to deal with an actual real life business owner, and we're going to kind of diagnose and her specific situation so that it's a little more engaging and informative to the rest of the participants to understand what the questions that we need to be asking ourselves are. All right, so where are we? The consumer price index, last time it was measured is like 8.1%. When I asked the question earlier today, how many of you have seen price increases above that? About half of them said that they had experienced price increases in their business above the 8%. Shadow Stats is a very interesting website, does alternative measurements for certain government statistics, one of which is the consumer price index. He pegs it back to 1990 when the metric was changed, how they measured it with the federal government. And what he has seen over time, and what shows in this graph, is that the actual inflation, or at least the inflation as it was computed before they changed the methodology, is actually higher than what is actually being reported. This is the 8% that we're being told. Shadow Stats computes it at over 12%. So I think that whatever you're experiencing, even if it's not the 8%, is normal. I'm going to show you some graphs here a little bit later to further support this, but I think we're at the beginnings of a recession. I think the idea that a recession is coming is not factual. I think we're in a recession. I am not an economist, so don't, and I don't purport to be one. I'm just observing what I see, and I think that having like looking at this last year, looking at the data and said, oh, we're in trouble. We need to raise prices because it's heading our way. Even having a few months jump on this information, I think, can help you in weathering the storm. So where we are, I think we're at the beginnings of a recession. I think that inflation is higher than it has been reported. And the way I put this to the group last time was, if you don't believe me, have you actually seen any productivity gains year over year? So your revenue, your dollars are more, but are you actually doing more? Or is it just passing on price increases? So this next slide that I have is another one I found earlier this week that I thought was a good graphic of the change in the price of a hamburger over the year to year. And if you look at those numbers, none of them are 8%. They're all over 8%. So, how you calculate inflation, is different for virtually every business because we don't all consume the same things. But I think the consensus is that it's higher than 8%. So let's move to this fine piece of data. This is from Greg Crabtree, CPA from Huntsville, Alabama. He likes to tell everybody that he's just an old chicken farmer from Huntsville. But the guy's brilliant. And this data that he has, they have a firm that consults for small and medium-sized businesses. And this is the data that he has compiled. This is what we were looking at 9 months ago. It was showing that we were going to have price increases. And he was spot on, and it's been updated. So we're looking at 5 years worth of data here. The blue line is revenue growth. So, revenue. So this is obviously growing. So this is revenue. Orange is labor cost. When I looked at it, let's see here, back here, we were seeing that all, for a year, the costs of labor was exceeding the rate of growth in revenue, which I think, everybody that I've talked to, that's their experience, is labor costs have gone up. A lot of it is a labor shortage, but the cost of labor has increased. What's interesting is extending it to March of this year. What we're seeing is it's flipped again, where revenue is growing faster than revenue is growing faster than labor costs now. So we're back, and that is generally an expansion metric. Like if revenue is growing faster than labor costs, that's a positive thing for the economy. But look what's happened down here to this gray line, which is the non-labor operating costs. For the last year, it's been growing fast. So this is the inflation that we experience in our business. All of our vendors increasing their prices. That's what this gray line is. And so essentially what's happened is your revenue has been going up for the last year, and it's exceeding the labor cost. But our pass-through costs that are non-labor costs that we have to pay as business owners is growing faster. And so look at our profit. The yellow line is the net income. It's flat. So this data right here, the way I'm interpreting it is we're about to hit a recession, because this is not sustainable. You can't increase revenue if you're not increasing your bottom line. It's not gonna sustain. So this is part of the data that I say, well, I think we're headed for a recession. I don't think that the recession is necessarily going to mean that we're not going to have inflation. I think you can have both. That doesn't make sense conceptually, but it is possible. I don't think the supply chain issues have been resolved. And in some cases, like with the issue in Europe with Russia and Ukraine, some of those have exasperated. They've gotten worse. And energy costs, we've had 3 years where we have not put any capital into drilling new oil production in this country, and it's catching up with us. So if we've got systemic problems in the supply chain and we've got increased energy costs, that's going to be inflationary in a lot of areas. The flip side of it is seeing data with like Walmart and Target letting people go. They were overstaffed. There's certain segments that I think you're going to see this whiplash where it's going to be recessionary. You're going to see prices go down. So all in all, I think it's going to be a rocky road the next 12 months. There's no question about that. So how do you deal with it? All right. So, I've broken this into 3 sections on strategy: business, pricing, and labor. But before you implement any strategies, I think you have to have some foundational elements to know whether or not the strategies are working. So, if you go out and implement a strategy and try something and you don't have these tools to measure it, it's kind of like just guessing. And you could guess you can just as easily guess wrong as you can guess right. So the foundational elements that I think you need to have, and I did a webinar on this first topic, the forecasting, with Jeremy earlier this year. You can go back and look at it on our YouTube channel. But essentially, forecasting is not budgeting. Forecasting is looking at the next 12 months and updating it on a rolling basis as your business performs. And the forecasting should project what you think your business is going to do. What's your business plan? What are your strategies that you're planning? What does that look like in numbers? The forecast allows you to predict, yes, but also then look at the actual compared to forecast. And that gives you the answer to, are you doing the right things? So the strategies that you're trying, is it showing up in the numbers? I think that's probably the most powerful thing that we as CORE can do for you, but you can do for yourself, is do the numbers support that what you're doing is working? It's you come up with a business strategy. It either works or it doesn't work, and it will come out in the numbers. The second thing is having key performance indicators. When we're dealing with pricing and we're dealing with inflation, I think it's key to have at least gross margin percentage and direct labor efficiency rate. Again, I've done a whole webinar on that subject as well. I'm not going to go into detail on what the direct labor efficiency ratio is. And I said rate, it should be ratio. But very, very basically, it is the amount of gross profit that you make divided by your labor cost. Think of it in terms, if I spend $100,000 in labor as a service industry, I should be getting $2 in gross profit for that 100. So I should get 200,000 for the 100,000 that I spend on the labor. If not, then there's work to do. If you are in more capital intensive industries, that ratio is higher, can be 3 to 1 or higher. So I'm not going to go on that anymore, but just go back and watch that webinar if you want some more information on the direct labor efficiency rate. So I'm going to start with business strategies, and I've got a set of books reference that I'll give you at the end. This book by Herman Simon, The Confessions of a Pricing Man, is exceedingly dull. He's an economist. He was a professor. It's very dry reading, but it's exceptionally good data because this guy, Herman Simon, basically invented the concept of consulting on price. He's done all of his work with larger entities, so it doesn't always translate to the small business, but the principles do. And his statement of this strict profit orientation, every business has to have that, may sound very simple to small business owners, like, yeah, we got to make a profit. In larger companies, not so much. Sometimes the politics and the different agendas, making a profit is not always the issue. But he said in his book, there's 3 elements of what make up a profit orientation: create value, quantify the value, and communicate the value. Now, I had this set up for you, as in that's what CORE does. That's the finance and administrative function of a company. That's the quantifying the value. Creating the value, that usually is in the operations, people doing the work, and then communicating the value is the marketing function. But looking at this from taking away from this is your strategies and your decisions have to have the goal of making a profit at the end of the day. That's key, and it starts with creating value. So looking at it from a business strategy standpoint, I think it is important for all businesses to look at this on an annual basis, of looking at their longer term, like 3 to 5 year targets and strategies, their goals and their strategies. But this business disruption with all of the pricing increases and stock market and possible recession and political instability, it might be a good opportunity to look at it if you haven't ever done it before. I mean, I think you should do it as a matter of course, but it might be time to revisit it. And we're going to talk about this real briefly on the next slide of what that could start with. But basically, reevaluate who your target customer is and your strategies to doing business. That may sound simple, but most business owners that I have worked with have not really given it the amount of effort and energy that it needs, because those are not easy questions to answer, as we'll see. Beyond that, I think it's key, and I think it's something you should do on a regular basis, but now is a good time to do it if you haven't, is review your profitability by customer or client. I think this is a fairly simple exercise as long as you have the data of listing your clients and customers by not just their dollar volume, but their gross profit volume, and then ranking them top to bottom, who gives you the most and who gives you the least. It's not uncommon in small businesses where they have a high paying customer, high paying client, but the margin's not very good. And it's, well, we got to keep that business because it keeps the lights on, it pays the bills. You know, when you're starting out, you'll take any customer. And the problem is that then keeps you from having capacity to grow with better margined customers. Jack Welch at GE was infamous for taking the bottom 20% of the company and the employees and firing them every year. I'm not suggesting that you go to that extreme, but looking at it on an annual basis and taking that opportunity, if you haven't done it before, of are there some customers or clients that you just need to stop doing that work for them because it's keeping you from doing more profitable work. Same thing with the product service lines. So this gets a little more complicated. It's not just to draw a line and do a table and lop off the bottom, because there's usually interplay between products or services. So, if you have a service that's tied to a specific product, in other words, if you don't sell this product, you can't deliver that service. So you have to look at the correlation between the products and services. They're not always standalone. And getting rid of one might affect the ability to sell the other or deliver the other. So that's a little more complicated, but it's always a good idea to do that and do it if you haven't done it recently. This slide is adapted from the book Lean Startup, basically a book, very infamous book, about how to do a startup on a shoestring. So, the whole bootstrapping kind of idea. One of the things that came from that was this concept of a lean canvas, which essentially is just a one-page business plan. But I find that this doesn't just apply to startups. This is any business. And it's really starting over here in these first three of defining the problem for your customer in your customer's terms and language that they speak, as well as the solution that you offer, and tying it together in a unique value proposition. I was working with a group of entrepreneurs on this last week, and the struggle usually is that we define the problem for our customers or our clients in our terms, not their terms. We don't use their language. This book here, Extreme Revenue Growth by Victor Cheng, recommend it. It's not on the list that I'm giving you, but he defines it as you have a solid business if you have a customer that has a problem, that they know that they have a problem, and that they're willing to pay for it. A lot of times as we go through and we do this work and identifying the client's problem, we're doing it in our language and what we think the problem is, but they don't even know that it's a problem. And if it's not a problem that they understand and therefore are willing to pay for, then it's really hard to sell them that. If you can't clearly define it in terms that they understand, pricing becomes an issue, right? If these three elements are clear, pricing is not an issue. Now, that doesn't mean that it's economically sustainable. In other words, the price they're willing to pay is something that you can deliver and make a profit on. That doesn't guarantee that. But what it does guarantee is if you define the problem in their language and the solution in their language, and you can clearly define to them how it's unique to your competitors, the price resistance goes away, because you're saying, I'm going to solve this for you, and this is all it's going to cost. All right. This, by the way, this is, you can Google Lean Canvas. I recommend Lean Stack. It's a website, got a lot of good free tools around the lean startup concepts. All right, now next, labor strategies. Don't have a whole lot on this. Going back to the direct labor efficiency ratio, the first thing is don't hire anybody. I mean, if your direct labor ratio is not where it should be, if it's like below 2, then you don't hire, because you have enough capacity to do what you need to do. You may have to rework processes. You may have, like in our business, we went through quite a big change recently. We reorganized our organization and changed departments and moved people around. We reworked our processes because we hadn't reached that target labor efficiency ratio. We couldn't hire anybody. We couldn't justify hiring anybody, but we still had efficiency problems. We had problems getting some of the things done that we needed to get done. So reworking those processes, involving the team members that are delivering the work in that process, but don't necessarily expect them to be able to come up with the solutions. They can tell you where the problems are. They can tell you where their bottlenecks are, where their inefficiencies are, but they're not necessarily going to be able to give you the answers on the solutions. You may still have to participate in with them to give them the tools to help them solve the process problem. And then third is cross-training. So you may have overall capacity that you don't need to hire anybody, but you may still have bottlenecks at different points. We ran into this with our restructuring. We had a problem with onboarding clients. So we reorganized or redid our process so that we freed up some capacity there. The other way to address that is with cross training. So you've got excess capacity elsewhere in the organization, is get them to help. It's not just a matter of being a good backup if something should happen to that person. It's also being able to pull in some of that excess capacity they have. It's not the best. It's not as efficient as hiring somebody specifically for that position, but it'll work in the interim. Pricing strategies, surcharges, fuel charges. I'm trying to figure out how to do a fuel surcharge on a service business. I'm figuring it out. That maybe you've got some insight on to how to do that, Dorinda, if you figured it out. But I've seen a lot of this come back, a lot of fuel surcharges, especially with people that are delivering goods. But look at temporary things that you can charge for that are not permanent price changes. The second pricing strategy in dealing with these increasing costs is look for a premium offering. The Pareto principle says that 20% of activity, human activity, generates 80% of the results. That is across the board when you're dealing with humans. What it means in our context of dealing with pricing inflation is that approximately 20% of your existing customers will spend 4 times as much as they are currently with you. And if you take that curve on up, the 20% of the 20% or the 4% of your customers will pay you 8 times what they're paying you. Now, that's not to say they're going to give you 4 times or 8 times for the same thing. That's not what I'm saying. What I'm saying is that that relationship has the potential to generate that much more revenue. I don't know what the premium offering might look like in your business, but I would definitely look at that as an alternative. The reciprocal of that is a discount offering. So maybe you cut your price 20%, but you eliminate all of your costs so that you're just doing it bare bones. The thing I put parenthetically there is, if you have a premium brand or you don't want to damage your brand and your pricing, put it under a separate brand. You don't have to do it as the same company. But those two are two different options on dealing with rising costs: premium offering, discount offering. So what happens if our prices go up? If the prices go down, downturn in your economy, over capacity, all of this built up inventory, et cetera, all of a sudden, prices are going down. Give discounts on volume purchases rather than giving discounts across the board. So if you give buy 5 get 1 free, go buy 5 get 6, your profit is going to be better than if you just took that 18% or whatever it is and did it across the board. I didn't give an example and go through the math, so you're going to have to trust me on this one, but it's generally better on your profit if you give incentive to do additional volume than it is to cut your prices across the board. Along with the premium service offering is, what are some ancillary or additional services that you can bolt on to your service offering to help protect your price? So we're not lowering the prices, we're just going to add on a service. And generally looking at it from the long-term perspective. So, recessions don't last forever. You don't want to sacrifice your brand, your pricing for the future by giving it all away during the downturn. All right. I just covered in 30 minutes what I did in 55 minutes. I'll pause to breathe and see if I have any questions. So any questions so far before we go to Kane and do the hot seat? Put it in the chat. Okay. So we are going to move to the interactive portion. I am going to bring in Kane Corder. You're with Presidential Lifestyles.
Presidential Lifestyle, no S.
Style, not plural, sorry.
Mm-hmm.
Tell me, give us the Reader's Digest version of what it is that you do.
So I am a national certified counselor and the CEO here at Presidential Lifestyle, and we are a mental health company focused on reducing stress and burnout while increasing employee engagement by connecting to the company's vision. So we do that using our program called Sync Clarity, and that program combines data analytics, mental health, and what we call thought leader surveys. It's one solution. Those three components are one solution to solve three problems. And we typically work with mission-driven companies, usually mid-size, about 25 to 200, 250 employees. And then, so what I would say is it's the company that cares about their team and wants their team at their best, personally and professionally. So they realize that it's not just the hours they spend at work. It's also, especially now that we're working from home, it's also what's happening in their lives that's affecting their company and them being able to connect to the company's vision. Okay.
And what is the current situation you're experiencing as far as pricing and inflation, either your costs or pricing of your service to your customers?
So a big challenge of ours is we used to focus on CEOs alone, just the CEO. We pour into the CEO. We do mental health for CEOs. And then we realized that it was the team as well that needed the work. We would consider ourselves B2C because we were talking directly to a person. And then we shifted to B2B. And B2B pricing is different than B2C pricing, even if we were working with CEOs. And the pricing is different because we now have to hire people, because there was a scale part that happened in there too, that we now have to hire people to do some of the work that we used to do. Jason, my partner, who does the data analytics, the data science, I do a lot of the mental health. And then when we started bringing on the whole team, we needed other therapists, we needed other data scientists. So that's kind of where we are now, those two challenges. It's like the language, you talked about the language, and speaking the B2B language is different than B2C language. And then pricing is different from B2B to B2C. And then pricing needs to go up and labor costs go up. Also, our core value is that everyone who works for us, works with us, feels like they're getting paid to do what they love. So, and they're getting paid a lot to do what they love. One thing about therapists, the industry, is that because you're a service person, you're supposed to do this for free or very little. And we are changing that dynamic. So we're disrupting the mental health world as well as disrupting the employee engagement world. And we're disrupting the mental health world on both sides, what the therapist thinks as well as what the client thinks.
Okay. So let me rephrase what you said. The pricing issue is primarily changing from a B2C to B2B. And then you have your costs are going up because you're having to hire people. You can't do it all. Is that accurate? Yep. Okay. So,
and we are on the higher end. So that's you talked about that lower end, higher end. We are not a discount brand.
Got it. Okay. What would you say, and this is not a, well, it's not an inflation thing. This is a marketing thing. What would you say if I told you that there is no B2B, that it's all B2C?
I want to believe that. And I've been seeing some of that, research or whatever, marketing people talk about it in that way, because you're still talking to a person. But I have learned or seen a difference in the language where some of the language might say you, or some of the language might say your company, right? And so those are the nuances. It's really the nuance that I'm trying to learn right now. But I do get what you're saying, and I'm trying to believe that, but I have felt the difference in not having the right language. So help me out there.
Yeah, and I think that even if it is B2C, like one person's making the decision in a larger organization like you're marketing to, it's the decision making is more complex. There are more than one buyer, and that poses different challenges because your messaging might have to be different depending upon who you're pitching to. So this concept of a lean canvas, we kind of discussed it last week in preparation for this. What are your thoughts on that as far as what is the problem that you solve for your customer?
So one of the problems the biggest problem, I should say, that we solve is that they feel like they're doing something to help their employees reduce stress or not be burnt out, but it's just not working. And they're kind of like, was supposed to work, so why would we do something else? So that's like their problem and our problem I just described. So their problem is like, but we have this thing in place and they're not using it. So we tried.
That's fascinating. I read something on LinkedIn earlier this week. It was a survey. And I don't remember who did it, but it was one of the big survey, Gallagher or something like that. But it was the question of, does the employer think that they're helping their employees versus does the employee think their employer is helping them? And there was this huge disparity. Virtually all the employers thought that they were doing things to support and help their employees, but not so much the employees thinking that reciprocally.
Exactly.
So then it really is that's interesting. So would it be safe to say that the problem you're trying to solve is that gap that
Yes,
they think they're helping, but their employees don't think they're helping?
exactly. Yep. And
Okay.
a lot of what's already out there. So here's our value proposition. A lot of what's already out there is just pointing out the gap, pointing out the gap, pointing out the gap. But I can tell you you have a broken arm, but unless I'm giving you a cast, I'm really not helping you. So we are giving you a cast. We have the second part, which is the mental health, right? So we have both parts in one. And we have a thought leader survey. So we're also polling your customers so you can hear what your customers are saying, your prospects are saying, and we're making you the leader in your industry by polls like what you read, like information like what you read, so that they become the leader in their industry. And everybody wants to work for the leader. Nobody wants to work for number 2 or 3.
Mm-hmm.
So that's part of what we do.
So what are their alternatives? You know, when I talk about pricing with businesses, I as accountants, we're trained to look at the costs. You know, it's kind of like engineering. We're cost engineers. So I was like, well, this is what it costs you to do. So you got to price it at like twice what it costs you, or something like that. But the reality is that that's not how prices are determined. The prices are determined by the value perceived. And the value perceived is how well you solve the problem and what are the alternatives. So have you, in developing your pricing, is it more what your competitors are pricing, or how have you landed on?
Yes. So in developing the pricing, this is our big question. So we don't care about being the lowest. We don't necessarily have to be the highest, but we definitely are premium, and we want people to see us as that, as you know, and maybe many of the listeners. When your price is too low and people expect it to be higher, they see it as like, oh, they must be doing something wrong if they're that low.
Right.
So we don't want to fall there. We definitely want to fall where people say yes to the value. And if the price is a challenge, we want to be where it's a no-brainer because of, here's what I'm thinking, and you can tell me as a professional, some of what we do is a luxury. It's not a must-have. Yes, they care about their employees, but they care more about their bottom line. So if there is money they need to get off of their books, this is that kind of service where you get to pour back into your team rather than giving that money to the IRS. So that's kind of what we've been thinking when it comes to pricing. We are a premium price, a premium service. Right. So what we're running into is, we're not a software company yet. That's something we're developing, but right now we're working as a service company. Mm-hmm. There are softwares out there that do similar to what we do. Mm-hmm. And then there are mental health companies, usually they're coaching companies, not powered by therapists. So they're coaching companies that do similar to what we do, but nobody that does all 3 of the components. And the thought leader part, even though it's the gravy, it is the most powerful gravy that makes it so delicious, because once you become the leader, once you have that survey out there, you can use it again and again, and you can do another survey. It's just this really powerful anchor to becoming the leader in your industry, which then makes your employees more happy, because it all is cyclical. And that's the part that people don't see, is how it all relates.
So is it a situation that, just talking through this, is it a situation where you would give a company exclusivity in their industry? Like, we won't work with anybody else in this space? Mm-hmm.
Yeah. So one thing, I'm looking forward to your list of books, because you always recommend really good books. And one of the things I learned in one of the books was that exclusivity, which I hadn't even thought of before. And that's an idea. Mm-hmm. We haven't unpacked what that idea would look like, but it is definitely an idea, but I'm not sure how to execute on it.
Maybe as a premium service. Like, so, if you want the premium, It's going to cost more, but you get the exclusivity. Right.
Yes.
One of the things I'm thinking of, like if I'm on the other side and I'm buying your service, defining these soft costs, like my employees are happier, my employees are more content and blah, blah, blah. How do I quantify that? Like, to compare, because here's the thing. We make decisions emotionally. We've had this conversation, but then we fill it with rational thought.
Yeah.
So giving people an anchor to base their pricing on, it's kind of like, this is the bad example for this situation, but it's like the small popcorn at the theater. No one's going to pay $5 for a small popcorn. They're going to pay $5.25 for the medium. They don't intend to sell the small popcorn. It's just there to give you a reference point to the price that they want you to buy.
Yeah.
So if we take that thought process to what you're doing, is there, whether it would be on retention or productivity, is there a way to quantify those dollars to give them a rational basis to justify the expense, even though it's not a direct comparison?
It is. And that's why we have the data science department. That's the data science as we collect the data, but it takes time to do that. So that is what makes the decision. It is a long-term decision because we need at least 4, but I like to say 6 months of data so that we can show you the difference. And also that gap that you talked about, there is nobody in your company that your employees are going to feel comfortable, or your employees may not even know how to articulate the gap. So those are two different things. They may not know who to talk to articulate it, and they might not even know how to articulate it, but we know how to extract that information. So that's kind of the difference in how they would value, how they see the value. Oh, now we at least get them to talk to us the right way. Oh, now they can articulate what they're feeling. Oh, now that gap is closing. We are doing the things that they do want, but it takes time to collect that data.
So we talked about the definitive sales proposition when we met last week, correct?
Mm-hmm.
Okay, so the formula of if then else.
Mm-hmm.
Okay, so if the company qualifies, they're in your target, and if they, whatever the skin in the game is, they participate in the meetings, they do the education, the employees do the education, they fill out the service, whatever that is, then you're going to receive X, this excellent benefit. How would you define that excellent? How would you quantify that excellent benefit? Because the next question I'm going to ask you is, what's the else? What's the, like, in my mind, it's like, well, you increase my employee retention by X%, else I got to refund my fee. But that way the quantification, I don't know if
I get it.
Okay.
So the jury is still out, the data is still out on that, is what is the easy answer to say. And the reason is because my partner has been doing this for 6 years for one company. And then we brought on a second company in 2021. So almost a year ago now, we brought on a second company, and we would like to have 2 more kind of early access clients that are willing to say, okay, this is how the change went. Then we can come back and say, this is what we expect, because we saw it in the first client. We're seeing it in the second client, but we feel like we need a little bit more data to really be able to stand behind the numbers that we see. And then also there is a dollar amount that they can then, as the number one in their industry, the first client that we did this with, because they are so entrenched in their industry, the amount of money they can now charge, because they are the experts, they are the authority, and nobody really wants to work with anybody else but them. They get to turn down clients if they can't reach their number. So it also allows them to hold to their price very steady. So there are 2 matrix that we have to look at there, and that is what's happening inside the organization as far as the morale and the employees and the health and all of that, but also look at those numbers. What is the dollar amount that they're actually able to charge more because they have such a strong organization. So we're still doing the numbers on that. So I'm not
Okay.
sure yet what that growth needs to be. And that's what we want to collect from the two
Okay.
early access clients.
So when it comes to staffing, like additional counselors, et cetera, is it clear now with the direct labor efficiency ratio, is that with that concept, what you can pay for what you need done? So that probably was not real clear. So if you break out your process into its components and you're thinking, okay, I can hire somebody to do this, I can hire somebody to do that, do you have clarity on what you can afford to pay them? Not what the market says they're worth, but like the economics of the process.
I think after seeing your last webinar, I think that's what Dorinda and I are going to talk about next, because I can't do that on my own, because that is why I hire you all, because I'm not taking time out to think about that. I will not. And yeah, I need Dorinda for that. So we already have our next, our quarterly meeting set. So that's one of the things that we will talk about, because I'm not 100% sure, because it's still a little confusing to me, and I'm just not willing to give that more space because I have you guys.
Let me give you my experience when I started out, because that might give you and the rest some insight. So when I started, I actually bought a franchise. If you believe it, there were more than one accounting franchise out there when I bought this 25 years ago. I don't think any of them have survived. Anyway, their model, it was a franchise operation. They had it all figured out. Like, this is you as the franchisee, you as the owner, this is what you're going to do. And then this is what you're going to hire out. Because, starting out, there's only, 100 hours in the week that you can work. Right. So
if you're willing.
right. No, I mean, I was 27 and didn't know any better. So the first thing that we did was we hired a bookkeeper. That was the first hire that you had. And it was, I hope there aren't any bookkeepers listening. It was basically considered the lowest skill thing that you could, it was the least efficient thing for me to do. Yeah. And frankly, in retrospect, I'm an awful bookkeeper. I don't like doing it. It didn't take me 25 years to figure that out, but that was the first hire. And then the next hire was this manager function, the accountant function. But the whole thing was worked out because they'd seen companies, they'd seen franchises grow, and they knew this is when you need, when you have this number of clients, you need to hire a bookkeeper. And when you have this number of clients, but that's my experience with working with business owners is that the best strategy is to retain that only which you can do, which is usually the highest value, but also coupling it with, to the extent you can, what you want to do. I mean, it's awful if you're really good at something but you don't like doing it.
Yes. But we call those the ABCs. They actually use part of that in our process. And I am magical. I'm going to, at the risk of sounding arrogant, I am like one of the wisest people you will ever meet. Is talk about cursing. It's shit that I know that I have no idea how I know it. And that is why people come to me. People are like, she is like all knowing. I don't know how she knows these things about me. It's like, I can just see through you. And so because I can't train that is a gift. And so that's the only thing that I try not to train, because that I know is my gift. The other things, like whether it's therapy, and our therapy process is totally different than any therapy you've ever experienced. I can train therapists to do that process. Jason can train data scientists to clean up the data the way we want it cleaned up. Like all of those things we can send out. But when I go out to speak, and then I can just point to audience members and tell them stuff about their lives, and they're like, wow, how do you know that? That is what we can't train, but that is our secret sauce. So
Right.
there's a part that I need to do to kind of generate that like spark. But sales, I'm a number 2 salesperson. I know this. I'm hardly ever number 1. So somebody else could do that.
Mhm.
Somebody else can do, like you said, I have you guys, I hired you. So you guys
That's
do.
interesting. That's interesting you say that, because most of the time the business owner is the best salesperson.
I know
That's
why
interesting.
I'm not. So I know that is interesting, but I would say neither Jason or I would be the number 1. We are number 2, mainly because we do get stuck in our technical and our language. I speak a language that most people don't speak. And because I have metaphysics background, some of my language can get a little too woo-woo and magical.
Right.
And so I try not to do it, but I do it anyway. But there is somebody out there also. Oh, I'm going to sound so sexist, and it's recorded, but men
It's
do
out
a
there.
better job selling this than women do. Sorry, ladies. I am so sorry. I can explain later when we have more time, but men do a better job selling this than women do. So for that reason, me stepping out and letting a man take that sales position works better in this particular thing. I'm not saying across the board, so I don't want to get emails
Right.
and letters. I'm saying in this particular
I was gonna
thing.
go fire Michelle. Evidently, I got the wrong person. No, Dorinda says no, I can't.
No, just in this particular thing.
Got it.
Because it is emotional, logical. You have to be able to switch between the two really quickly and really easily. And it is a skill. And usually a man possesses it really easily, just naturally.
I'm going to wrap up with another call for questions. If anybody has any questions, comments, love to answer them. My email, again, is cbrim@coregroupus.com to ask if you don't want to ask in this forum. Love to hear what you have to say or have questions about. This is it's a very important topic. It's a very immediate topic that we need to deal with. And as I told the group before, I don't have all the answers. I'm just an observer with some experience. And so love to have an ongoing conversation, continuing conversation about these pricing questions, about the profitability questions, about how to make sure that you are making the money that you need to make in order to live the life you want and to sustain the business beyond you.
I do have a question.
Yes, please do, because I don't see any in the chat.
So you talked about, so my rudimentary way of figuring out pricing right now is pretty old fashioned. And it's like, okay, I add up all my costs and then I just double that, right? At least. And then we are a premium service, so I might put a little premium on that. That's kind of right now where we are. However, that I don't know if that's old way of thinking. And then the second part of that is there are some of those costs that do every single client that we get, they have a cost associated with them, with us. And then there's some costs that just, they stop at some point, no matter how many clients we get, this is the cost of that. And but I'm adding them into every single time. And I don't know how to separate that.
Well, I think getting caught into the engineering the costs of pricing is a death trap. I mean, so I would say flip it. As we were talking and you were describing things, I was thinking, you said that there's people that do the analytic part and there's people that do the therapy part, but there's nobody that does both. Is that, Dorinda, are we keeping you up? Jiminy Christmas. So what my thought is in the pricing is that you could offer the services independently of each other and then make the pricing on those the small popcorns to support the pricing for the combined service offering.
Yeah.
Like you don't ever intend for them to buy it separately.
Yeah.
right?
And they would be like so ridiculous. Like, why would you not like the 25 cents?
Exactly.
Yeah. Okay.
Exactly.
Okay. Yes. Yep. Okay. That makes sense.
Hope it helps.
It does, because we've
Well,
been discussing it. We actually were in debate, like, does it water down kind of what you talked about earlier? Does it water down that we offer it? And we're saying it's powerful together. You want it together. It's like, but you also offer it separately. So if it's so powerful together, why do you offer it separately? So because you might not be ready for the whole package, right? You
Sure.
might be on a diet and only
And that means
want
what's going to happen is you're going to get a premium price for that service offering.
Yeah.
Because you didn't want to sell it for that anyway. You didn't want to do it. So you priced it ridiculous.
Yeah, exactly.
It's a small popcorn. No one's going to pay that much for a small popcorn.
Right. Yeah. Awesome.
Well, thank you for being vulnerable and coming on and sharing your issues with us. I appreciate everybody in attendance. Dorinda, I hope we didn't put you to sleep too early. You guys have a wonderful rest of the day.
Yes,
Wave to the
Dorinda,
camera
you know we're going to have much to talk about, right?
It is off. All right. See you guys.